Good morning, everyone. I'm your host, Ryan Rozbiani. Welcome to Market Simplified on the Place Your Trades Network. We're the network that focuses on trading daily options using CME Group's event contracts that trade the indices, metals, energy, and even for my crypto friends, Bitcoin futures markets. Today's broadcast is brought to you by Crudele, which has built a custom app dedicated to trading event contracts, which is what we use here at Place Your Trades. Welcome back to a brand new episode, the very first one for the month of August, and we are off to a very, very crazy start to the month. There's a lot that I want to discuss with you guys today. There's a lot that we need to cover because there's a lot happening that shouldn't have probably happened. So we're going to jump right into market overview because I have a lot to talk to you about. So right off the bat, I want to talk about this downgrade that kind of came down the pike with our friends at Fitch. Not exactly our friends. So we know that Fitch, so let me just adjust some Zoom situations here for you guys. The United States credit rating was cut from AAA to AA+. Now, I don't know about you, but if I took a AA+ home to my parents, they'd probably be very happy. But this AAA situation has caused some heartburn, for lack of a better term, in the stock market. So the last time this happened was actually August 5th, 2011. And the reason this happened back then was they were trying to raise the debt ceiling and they couldn't. They missed the deadline. The markets were in kind of a shutdown-ish situation. The credit rating was downgraded to AA+. And then it wasn't upgraded until just recently last year in 2022. And the stock market then fell significantly. We had a 5.5% drop in the Dow, 6.51% drop in the S&P, and it took about 6 months. If we take a look at this graphic, it took about 6 months to recover and get back to where we were. Now, mind you, the reasoning that happening was terrible. It was like really bad. It destroyed 6 months of potential growth that could have happened because Congress was playing chicken, as they did in January. So if you're familiar, we weren't doing the show back then, but this is a topic that I've been covering since literally like late last year. Was the whole debt ceiling situation. I was like, this is going to be bad. If they wait till the last minute, this is going to be bad. And this was one of the things that I was very worried about. And when they got the deal, and they literally waited till the last minute and got the deal, I was like, okay, good. No one's downgraded us. We're okay. And now here we are 5 months later. Fitch hits us in the back of the neck. Now, the thing here is that there are side effects to this downgrade, right? And the side effects to this downgrade, I wrote a post on Twitter, but I'll really kind of let's summarize it real quick. Is it creates a perception of risk that the U.S. government, there's a lot more risk in borrowing, in our credit worthiness, right? So it's kind of like, think about like your credit score as someone who wants to go out and get a loan for a car. A 720 is less risky than a 680, right? A 680 is much more riskier. Borrowing costs can be affected because of this. Credit ratings impact the interest rate or the yield that country might offer to investors to purchase its debt. So that's one thing there. Investment mandates might change. Some institutional investors, you can only have AAA rated securities. What does that mean? Now that we're not a AAA rated security, they might have to flush and sell those and replace them with AAA securities from places like Denmark, maybe, for example. That's a place that's still AAA rated. It has an impact on the US dollar and the economy. This is the most important one in my humble opinion. It says a downgrade could potentially weaken the US dollar if it led to decreased demand for the US assets. This could impact the broader US economy, including everything from interest rates for consumers and businesses to the price of goods and services. This could have an issue. This could play a bad factor for us if things get ugly again. This will kind of have more of an impact and an oomph on our situation. And of course, the credit rating confidence for the U.S. economy is affected. That's literally the baseline reason why everything is moving. And the thing that they cited for this was two big things. One was that the Congress and the U.S. government plays chicken, essentially, putting it in layman's terms, when it comes to deciding monetary policy. They wait till the last minute, and this isn't good. This is not good. And frankly, this is one thing that I hate, right? There's too much showboating. There's too much grandstanding right now. And they're meant to be public servants, but they use these kind of events as bargaining chips in order to move stuff across the board for either personal reasons, like we saw with some pipelines, some gas pipelines, or political reasons, which we saw for some grandstanding because both sides want to come out as a winner and make the other side look like a loser because, mind you, we are in election season for 2024. We don't care about politics here. I'm just hitting some highlights. The other thing that they noted, which is the thing that I've been worried about from the beginning of this year as well, because rates have gone up, is our interest payments on our debt. The United States spends money like a teenager with daddy's credit card. We spend too much damn money that we do not have. Daddy keeps going, getting credit cards from Japan, from China, raising money. Hey, let me borrow some more from you. Gimme, gimme, gimme. And right now we've gotten to the point that our debt is so expensive that it's going to hit almost 1 trillion US dollars annually in just interest repayments. Last year, to put that in perspective, we paid 480 billion in repayments. This year, it's going to be almost double that. Now, the reason I'm saying almost is because we're not exactly at 1 trillion. I think it's 970 billion around here. You can see that if rates go up again and we have to borrow more because we have to spend money, send money, you know exactly what I'm talking about. It can cause issues, and we can get to that 1 trillion very fast, right? You guys know this. You guys are well aware of how we spend too much damn money, but that's the situation that we're dealing here. That's the reason Fitch downgraded, and that's the reason the markets are kind of crying and bleeding, right? Parallel to all this, you might be thinking, what is happening with the economy? It is jobs week, right? Jobs week means we get ADP data for unemployment, we get some jobless claims data, we get some non-farm data, we get unemployment data. So I want to run through that with you guys today, because much to Jerome Powell's dismay, the labor market is still extremely, extremely strong. And this is confusing, believe me. I'm still trying to wrap my head around the fact that why this guy wants to destroy the labor market. The reasoning is he wants to create what's called demand destruction to try to reduce inflation. If there's less demand and a ton of supply, prices can come down. But the issue here is demand has not gone down significantly. The labor market has been very strong. Supply has still been an issue. We don't talk about it too much anymore, but the supply chains post-COVID are still a pain point across certain spots. Other spots went way too far and overproduced, like the chip sector that we're seeing now when companies like TSM are reporting. But other places, like for example, in food and agriculture, we're having issues still. Like for example, in India, they recently issued a mandate saying, hey, do not export non-basmati rice because we don't have enough in the country itself. And that's why you saw a run on the supermarkets this past weekend. There was videos all over social media that, hey, you got to load up on that rice if you want it. So that's the big reason why he wants a weaker labor market. And that's the thing that confuses a lot of people, so I wanted to make sure to explain that. So JOLTS job openings came in a little lighter than last time and lighter than expected. Still very, very strong. Ton of jobs are still being opened. That's a lot of jobs for 1 month being opened and created. So the labor market's strong there. ADP is what kind of knocked the teeth in when it came to this jobs data, right? ADP non-farm employment change was expected to be only 189,000. Well, it came in almost double that, 324,000. Less than last month, but still significantly higher. What does that mean? It gives the Fed the green light that, hey, the economy's strong. I can still keep kicking its teeth in. That's an issue for me. Initial jobless claims came in exactly right in line with what was expected. A little higher than last time, but nothing has really moved. Non-farm productivity took a nice big pop. I'm very happy to see that. Still, this is a preliminary print. Unit labor costs are coming down. So labor costs coming down is actually very good, in my opinion. This is something that I'm really happy about. Now, the big thing tomorrow is, if you've heard of wage price spiral is a phenomenon that's discussed where prices go up on goods and items because employers are raising wages. Companies see this. We've seen this in companies like Pepsi. Hey, people's wages are going up. I'm going to raise prices. You create a wage price spiral. It keeps just going up like a tornado. So tomorrow morning at 8:30 a.m. Eastern Standard Time, we'll be getting the average hourly earnings for year over year and month over month. It's expected to come down slightly for both. We'll have to see there. Estimates have been very, very conservative and have been coming out much higher than expected. I'm hoping they come in line or lower. That's what you really want there. Non-farms payroll is expected to be pretty much in line to what we got last time. Participation rate, same thing. But here's the thing. With the participation rate being in line, does not match up exactly when it comes to the ADP non-farm employment change. I'm expecting participation rate to go up. Now, this is a good thing. This is what we want. You want more people working. How might not want that? That's kind of like the double-edged sword that we're playing with right now. But we'll see it there. Unemployment is expected to come in at 3.6. This might actually come down because of the ADP might come in at 3.5. We'll have to see that there. And private non-farm payroll is expected to go higher. I assume hadn't to be fully frank, I can check an older screenshot that I have to see where the estimate was, but I wouldn't be surprised if they revised this estimate just a few days ago. And I'm just checking an old screenshot that I have on this other screen. No, they haven't revised it up, but I wouldn't be surprised if this number is also revised upwards. So that's kind of like the broader catalysts that I'm watching into tomorrow. Now, the funny thing here is, mind you, that a lot of the chaos has already happened this week, and people are still in fear. Remember what happened last time. The markets, when downgraded, fell 6.51%. Yesterday, we fell about 2%, I believe. Today, we're down another chunk. Let's just take a quick little look. I know it's not that part of the show yet, and we have one more thing to discuss in terms of earnings for tonight, but I want to quickly kind of cheat code to see what happened yesterday and today. So yesterday, we fell. I don't know if this number is accurate. This doesn't make any sense. Let me just double check a second source, because sometimes the calculation on this site is a little bit off. So I want to double check how much we came down yesterday. Just give me 1 second. So yesterday we came down 1.39%, and today we're down 0.2% so far. So about 1.5 if you want to add them both up. So essentially we closed the markets on Tuesday at 456 on the S&P parallel SPY, and today we're sitting at right now at 449. So we're down about $6. Nothing too crazy. Let's be frank. Look, just a few days ago, this number was a 52-week high. Just early last week, like when we hit this, it was like, oh, cool, 52-week high. So I'm not really too concerned about what's going on. This is a very, very, very different situation than what happened last time. The variables were very different, but I do feel like, hey, the fact that we've put on 1.2 trillion in debt just in the last 8 weeks is a freaking problem, right? Excuse my language, but it's a problem because we're spending too much money. The Fitch rating sees that, and the spending is just too damn high. I actually made a little meme for this for the show, and let me just grab it and put it on the screen for you guys, because I made this right here. The US, let me just double check that you guys can see this. Yep, you can see it. The US national debt is really too damn high from the Fitch ratings. If you guys know this guy, it's a meme from the rent is too damn high. But that's essentially in a nutshell there. Let's talk about what's going to be happening tonight that could either make or really, really, really break the stock market. We have two Goliaths, two behemoths, two of the biggest holders in the S&P 500 and QQQ, the NASDAQ, reporting tonight after close. That is Amazon and that is Apple. Now, one thing to also keep in mind, you have Coinbase reporting, you have Block reporting, you have Airbnb reporting, you have DraftKings reporting, Cloudflare reporting, Wish.com. Who cares? Wish.com doesn't matter. But Amazon and Apple are reporting. These are the two big Goliaths that are reporting. Before we talk about that, I do want to take a quick second to look at one of my favorite companies. Full transparency, I do have an investment in this company, but I want to talk about it real quick, just to kind of like machine or massage in some terms. You can see here that PayPal reported earnings yesterday. In my opinion, they did very good. You had a bit of margin contraction situation happening here, and they reduced the EPS. EPS guidance was raised for annual, but reduced for Q3. So it's kind of created a little bit of heartburn there. I like this company long term, but I wanted to show you this infographic because I love infographics. I'm a sucker for them, as you can see here with the debt. If there's something that can be discussed, I will go find an infographic about it. So I'm very happy with PayPal. I do wish that they had done better. There's room for improvement, but you can see here that companies are reporting mixed, right? Even sometimes you have companies like Microsoft last week reported a double beat, but their cloud services were down. It caused some heartburn in the stock market, and the stock took a dive, right? That's what I'm really worried about with Amazon. With Amazon, they can beat on headline revenue, headline EPS, everything could be fine. But then if they come out and say, well, AWS wasn't utilized as much as it was last quarter, or it's down year over year, you're going to get some heartburn in the market there. And I keep using heartburn in the market. We're going to have to come up with a new terminology. I'm going to talk to the producers after the show. I'm just kidding. So that's the big thing that I'm watching there. But Apple, on the other hand, Apple has a cheat code. Apple has so much goddamn money that even if they do bad on earnings like last time, they'll come out and say, well, we're doing a $50 billion stock buyback. And then stock goes up, right? That's literally what's happened since last time. I do think that the demand for iPhones has not curbed as much as people are advertising it. I hope I'm right, because I'm looking at TSM, who reported earnings earlier last week, and their smartphone chip production went up about 2%. They produced the chips for iPhones. That's kind of like the inference that I'm using. Previously, when that one number went down, iPhone demand was lower. We'll have to see. I do know the iPhone 14 hasn't been the biggest hit, because the iteration and the lookalike for essentially the iPhone X, the 10, 11, 12, 13, and 14 has essentially been very, very similar. Apple doesn't cut off the software as early as they used to. Back in the day, like if it was 2 iPhone iterations, by that time when the third one was coming out, your phone would not get any more updates. But now they've been very much more liberal with it. They've been expanding to it and allowing that, hence why people don't have to go out and buy a new phone. But then you have articles coming out like someone in India sold their child, I'm not joking, this is not a joke, to go out and buy a brand new iPhone. So it's a really weird situation that we have kind of going on here in the world of Apple. But look, it's Apple. I'm sitting in front of a Mac. I got an iPhone here. My Apple Watch is in the other room. I just bought a Mac laptop. I helped with Q2 earnings as best as I could. It's an ecosystem. People love it. You either love it or you hate it, and I hope they do well, because again, I'm an investor in Apple, full transparency, not in any of the other ones that are reporting today. But let's jump in and do some market overview. We started market overview a little bit already, if you're kind of keeping track with the section of the shows that we're on. But I want to kind of go and take a look at some of the today's price action that's happening. And in order to do that, I said, let's look at PayPal. PayPal is taking a beating. PayPal is taking a beating, much to my dismay. They worked so hard to fill this old gap up. We did fully fill it. Yeah. This was the gap up from last earnings. Bastards. Send us right back down. We got caught by this volume wall here, which I'm very happy about. Like, thankfully it held. I bought more of the stock earlier this morning. And it's trying to kind of find its footing. If it loses its footing here, I can expect it to come down to 62. 62 goes out. We'll probably come down to 60. Again, you have to realize that a lot of the turbulence that happened this morning with PayPal, with Etsy, with Robinhood was not just because of their earnings alone. It's also the market's kind of fear of what's happening with the Fitch downgrade. So this is the situation with PayPal. Let's take a look at Apple, because of course they have earnings tonight. Let's discuss to see what could happen. So kind of I have some Fibonacci's drawn here. I'm a sucker for the fibs. You guys probably know that by now. We're in a steep downtrend right now here, right? It's been kind of very ugly. Nice pop today, though. Very nice pop today on the S&P. On Apple. What am I saying? On the Apple. Earnings come in good. We break the 9 EMA. In my opinion, we have a path back to 193, 194. We break over 194.32. It's kind of like full, in my opinion, you got full steam ahead on the way up, especially if earnings are very good. You got a path on the way up. Earnings are bad, and they have no way to kind of patch the holes on this ship. We did fill this gap fully yesterday, so I'm very happy the gap filled. I really hate gaps on the chart, but this sucker gives out. We have a path back to 189. The 189 situation, 189 gives out. You do have a small gap here on the 188 situation. There's room to kind of come and fill this up. And if that gives out, you're back down to 186. Now, mind you, there are some very strong volume walls here. That's one good thing about Apple, is the volume walls are there to kind of help you on the way down, to kind of catch you like we saw it caught like it caught PayPal. So Apple is doing decently here. I'm hoping they do well. Last one for price action, we're going to take a look at Amazon, and then we're going to go to our event contracts, my favorite part of the show. Take a look at this. Like we were discussing volume wall, right? So we're doing a little bit of technical analysis fun here as well. You can see here that Amazon got caught by this volume wall. It protected it, it held it, and now it's kind of battling to get up. It's had a gap down. Amazon does well. This gap fills very quickly. Very quickly, this gap fills. You get over this 130, essentially. You get over 130, 130, 70, 130, 80 situation style here. You got a path to fill the gap very quickly. These are very small volume walls. Let me turn on the actual the values so you can see them. They're very quickly fill, and then you could probably see this go up. Amazon would have a kind of a beautiful reaction if things go well. I'm not an Amazon. I've thought about purchasing Amazon and adding it to the long-term portfolio because it's stupid of me not to. It's something that I use almost daily, whether it's through Whole Foods purchases or through Amazon.com itself. So it's kind of an interesting balance that I've kind of been like playing with in my head to add Amazon to my portfolio, but not yet. I'll have to wait for this evening's earnings. One thing to remember is that Amazon has a heavy investment in Rivian. And the reason this is important is because in previous earnings cycles, it's caused a hindrance. And we can see that Rivian this past quarter, actually in Q2, was slightly up about 9%. So that could kind of help Amazon in the tail end, because it'll be the first time in 2 quarters that Rivian actually had a decent quarter. And the cars are actually a lot prettier in person than you would expect. Looking at the S&P, we can see here that we have a falling wedge. We broke down outside of the falling wedge this morning on the 1 hour. It's breaking back into it. You need to get over the 9 EMA, then you need to get over 451, and then on your way up, break through this 20 MA for what I call fireworks to initiate and to get back into this original channel that we were in for such a long period of time. It all depends on Apple and Amazon earnings. That's why you're seeing some situation happening here today. You see the markets are kind of holding their breath, but not really, right? Markets, everyone was expecting, look, we went down to 447 today. We just made a brand new high of the day right now, because I'm looking at on this other screen. My neighbors upstairs have been just doing construction every morning since 7 a.m., so forgive me if the microphone is catching that. But this chaos is kind of ensued in the stock market, and it hasn't been that bad. Everyone was freaking out. And it hasn't been that bad, full transparency. It could be better, but it hasn't been that bad. So let's go to my favorite part of the show. Event contracts. You go to tradeovate.com. You're smart. You sign up. You create an account. You register. Link is in the description. You get the ability, as I said earlier in the show, to sign up to trade event contracts, and I'll explain what they are in a second. For the S&P, the NASDAQ, the Dow Jones, that sweet crude oil, gold for the gold bugs, the Russell 2000, the euro, Henry's natural Hubble gas, silver for the silver guys, copper. We even got copper. We got silver, copper, and gold for you. And of course, we made sure to have something for our crypto friends, Bitcoin. So across the board, you can trade these event contracts. I personally stick with the ES Mini because I like trading futures. I like the futures. I like the S&P 500. It's what I know. It's what I'm comfortable with, right? You come here, you hit the strike list, you get a list of stuff. These are 0-day expiration. That means today, when the markets close, sayonara, they're done. If you guessed correctly, if you picked correctly, you get to cash out at a maximum automatic win of $20 per contract. If you're wrong and you missed, sorry, 0, expired, worthless. Anytime during the day, you can take profits or cut your losses if you're on the wrong side of the trade. So let's take a look at what ES is doing really quickly and see where we can put our feet in the sand. Now, we are in a very turbulent ES these past few days. It has been nothing but pain, but I need to adjust this a little bit here. We are breaking out. We're attempting to break out of this resistance trend line here, which puts us at the 45.25. So let's take a look at this. Where's 45.25? So we are right here. We're essentially between these two barriers, right? We're over 45.20 already, hence why the premium is so high. And this is actually $13.75 raw. There's no 100x multiplier on this. But realistically, if you're watching for some movement here, the 20 MA, if you're juiced on the 20 MA and you believe the 20 MA is good and you're bullish on what could be happening into the day, you're going to want this to close over 45.30. So if you're bullish, you're probably going to be going with these 45.30 yeses. Now, personally, I'm not so confident the market is full gung-ho just yet on everything happening, plus the earnings coming later tonight. Sometimes you have some deleveraging into the close. So personally, I'm more on the side of no, we do not close over 45.30. And the reasoning being is for the earnings cycle, right? The earnings happening later this evening. So let me turn these drawings off for a second so I can kind of show you guys what I mean in like the rawest format. So I like to use something called Kelter bands because they include a standard deviation up and down. Plus they give you some tolerance in terms of risk as to where things are going. It includes some of the volatility of the markets into it. And frankly, they do well. They have some misses here and there. You can see you can write it down. You can go under. Same issues that the Bollinger Bands have. They're not perfect. But one thing that I have a lot of love for, which is the mid band, aka the 20 simple moving average, one of my favorites is if we get over that, it kind of tends to initiate what I call fireworks, meaning we have a path up. And if we can get over this 45.30, we have a path to 45.48 very quickly if earnings are good. And then if things go very good, you have a path to 45.55. 45.52, excuse me, right here on the 50 simple moving average. So if we can get there, things get good. But again, I'm trying to discuss kind of this for you for tomorrow, for as things start to kind of moving, because I'm not here with you guys tomorrow. But if earnings are ugly, and markets react negatively, right? Sometimes you can have ugly earnings and Apple goes $50 billion stock buyback. And then you go, okay, straight up. And then sometimes they go, hey, earnings sucked. What do you want me to do? Nobody wants to buy another iPhone. The 13, the 14, they look the same. We gave you the software for free. There's no reason to upgrade. You're going to take a hit. You're going to come back down to essentially the range of where this was, which is the 4,500 range, right? This 4,500, if I turn the drawings on, you'll see it probably a little better. 4,507, 4,500. This range, this 50 Fibonacci is really, really where the pain point is. And if you want to parallel on SPY, where that would be around this 443. So there's this gap here, and let me actually just draw it in for you guys so you can kind of see this thing. You have this gap here from 443. Let me see, just to be sure, 443. I'm just rounding up for friendly purposes. 443 to 440 to 445 essentially. Adjust the pennies, right? You've got a big gap. This gap, I think, needs to fill before we can start to see a movement up if earnings are bad. So that's kind of what I'm keeping in my head for two scenarios. But in reference to today, I'm sticking with no. We do not close over this 20 simple moving. But I want to check one thing. Give me 1 second to check one little thing here. So this is the thing. We could get a pop. You could get a pop, but again, I'm kind of putting my money on the fact that, take a look at this, since the first, the second, and today's the third, we haven't been able to get over this 20 simple moving average. Definitely haven't been able to get over the 50 simple moving average. You're flirting with the 90 EMA, but haven't been able to get over there. So if you want to make kind of like a more, I know it's funny to say, riskier bet, you say that we don't close over. What is this sitting at? 45.23. So you go, we don't close over 45. Oh, no. So you still have to go with the 45.30 because there's no in between. There's no $5 interval. So you'd go with the no. This is where I'd kind of be like, yeah, we're not closing over 45.30. That's what I would go with at $12 a contract. If I'm right, I get to cash out at 20. So let's just say we bought them at 12, right? It's 12 right now. So minus 12. So it's $8 a share. And then let's say you bought 20 of them. You profit 160 on a $240 investment. So that's 160 divided by 160 divided by 240. You get a nice little 67% mover there. So you can see there's money to be made in these event contracts, folks. Sign up, use them. They're a great, great learning tool in my opinion. I love how they operate. I love how simple they are. I love how they kind of do what's needed to get done. You know what I mean? They remove the risk of some of the stuff that can exist, especially if you're a newer trader. I highly, highly suggest you try them out. They're a very, very, very good learning tool. So I had a lot of fun with you guys today. I had a lot of fun. We got through everything we needed to get through, actually very quickly, just 2 minutes shy of our cutoff point. And I'm very happy we did this. I hope you're prepared for the upcoming earnings tonight. I hope you're prepared for the events tomorrow. We'll see you next week at 11 a.m. Eastern Standard Time. Remember, on the website for tradeovate.com, there's a ton of stuff that you can sign up and use, but you can also go to placeyourtrades.com where our team, let me just show you the website real quick. Let me just show you placeyourtrades.com because it's such a good website. I have to share it with you guys. Look, and I'm not just sharing it with you because I'm on the front cover today, but there's a dashboard. You got Chai Girl's blog. You got an FAQ, and all you got to do is put in your email, and you get access to everything for free, right? There's so much information, and of course, on demand, we've got our team here. This is our show. This is our team. I'm here on Thursdays, but every single day of the week, you got one of the members of the team coming in, providing value, making sure you're being prepared for the markets, absolutely free. All we ask in return is subscribe, hit the like button, give us a comment down below, and let us know what you think. Sign up at placeyourtrades.com. Get those emails. They make the morning so much quicker. Sign up for tradeovate.com. Start trading. Have some fun. I'm your host, Ryan. Thank you so much for watching the show today. I'll see you guys next week at 11 a.m. Eastern Standard Time. You can follow me on Twitter at Ryan Rozbiani. The link is down below. Bye-bye.